So y'all, I'm so happy you're here. I'm happy I'm here with you guys. I'm excited to be back. For those of you that may not know me, I am Brianna Beers, Bree to my friends, and I own the recently rebranded Bree Beers and Associates, formerly Lippa Beers and Associates. We help small businesses and individuals with tax prep and tax planning. And we love tax planning because it's our jam. It's where we get to strategize with our clients to help them minimize their annual tax burden and keep that extra cash to invest into themselves. So we are excited to finally be kind of rounding the corner to be able to actually do some tax planning with our clients this year. So we'll talk about that at the end of today. So you could be watching this in a variety of places. If it is not in our awesome Facebook community, Money, Taxes, and Finance for business owners, please head over there. It's a Facebook group. And if you are a business owner, you should be in there. So hop on over there. It's an amazing and supportive community. It is the quickest place to get information from us in terms of any, tax news or anything about our firm or, tax news. All right. And for those of you that are new to our Money, Tax, and Finance group, we do typically have 2 live sessions a week, usually Mondays at 10 Mountain Standard Time. We do our weekly training. And then on Fridays, we'll do our updates and Q&A. So let's go ahead. Today, we're going to start with the training, and then we'll end with a few updates and whatever time we have for some Q&A. Today's training I'm excited about. It's, I always owe so much on when I file my return. How do I minimize it? Right? So this is the number one reason most people end up getting a tax advisor. They get sick of year after year filing their tax return and owing so much money. So they hire a tax preparer to not only, a lot of people do it just to make sure they're doing their tax return right, like making sure they take all the deductions that they're reporting and making sure they're taking all the credits, taking everything they're qualified for. But if you have a good tax advisor, they should also be helping you minimize your tax liability. And that's what we are doing for you guys. We give these trainings and we help, our clients to understand where they can save on their tax bill every year. So the first thing I want to talk about. So again, we go back to you file your tax return and you're like, I owe so much money. I always owe so much money. How do I stop owing so much darn money when I file my tax return? All right. Well, let's back it all the way up to the very, very the most basic concept of why you owe money when you are filing your tax return. Okay, you guys. And the reason you owe money when you go to file your tax return is because you didn't pay in enough tax throughout the year. That's what it comes down to. Because we'll share tax planning strategies and tax saving tips, and that's all fine and dandy, but no matter how low you get your tax liability, if you owe money and you don't pay it in throughout the year, then you're going to owe it when it comes time to file your taxes, right? The first thing I want to talk about today is making sure you're paying in throughout the year. And I know that there are going to be some people that adhere to this mindset that exists that they don't want to give the government an interest-free loan, right? And I hear this all the time. I do not want to overpay on my taxes because I don't want to give the government a free loan for the year. That's fine. Okay. But I adhere to the mindset that I don't want to pay unnecessary penalties and interest on paying my taxes late. So obviously, the right answer to that is to find the balance, right? It's to find the balance where you're paying in enough to avoid that penalty and interest, but not, overpay by thousands and thousands and thousands of dollars to where you are, giving that tax or that interest-free loan. But I am a hardcore advocate of avoiding those penalties and interest. That's money out of your pocket that unnecessarily, okay? And it really can add up. So let's start with the different areas of income. Where are the different areas that you earn income and where you can pay your taxes, all right? Well, for most people, some in here, some not, but whether you are a W-2 employee here or you have a spouse that's a W-2 employee, or maybe you're a W-2 employee and you have your side hustle, regardless, if you are a W-2 employee and you end up owing tax at the end of the year, it's because your withholding isn't enough. You're not withholding enough in federal income tax on your W-2 wages, all right? And the easy fix to that is to update your W-4 with your employer, all right? And I know that the 2020 W-4 has gotten people all sorts of confused and just flustered. And maybe we will do a training on that later. I haven't gotten a lot of questions on it, so I don't know if it's really an answer or really a issue that you guys are having in here, because I don't know how many of you in here are dealing with W-2 wages, maybe have a spouse that this would even be helpful. If it is, let me know. Otherwise, I'm just going to tell you, if you or your spouse has a W-2 job and you continue to owe money year after year, update your W-4 and have more taxes withheld from your W-2 wages. So W-2 wages are a bucket, let's call that a bucket of income, right? Well, then you can have other income from like retirement. Okay, so that can be retirement, it can be Social Security, and the same thing, you might not be withholding anything because most retirement contributions and Social Security aren't going to withhold anything if you don't ask them to. So that's your second bucket of money is your retirement. Okay, then our third bucket of money, we're going to call it our investment income, right? So if we have our money invested with Fidelity or Charles Schwab or who else do we got? Merrill Lynch, Morgan Stanley, did I already say them? So if you have your money invested and you are making a lot of money, whether it's in interest or dividends or your capital gains, maybe you're taking money out, okay, and you made money on that. There typically isn't any tax withheld on those, on that money, on that income, all right? So if that income is substantial, it can affect your tax bill at the end of the year. The one thing I advise here is that all of you, if you have substantial investments, you should be meeting with your financial advisor at least once a year. And this is a question that you present at that meeting or at that meeting. Okay, you ask what your gains are looking like for the year. What's your taxable income looking like? And that is a conversation that your financial advisor should be able to give you at least a general grasp on. If the market's doing really well, even if you don't take any money out, you might end up having a lot of capital gains on your investments depending on where your investments lie. Again, if you are having that annual meeting with your financial advisor, which you should be, that's a question for you to ask. Again, they're not going to be able to tell you exactly how much tax on your investments, but they'll be able to give you a ballpark of what kind of income you're expecting or to anticipate and a ballpark of how much. Okay, and then you can go to your tax advisor with that information and see if you need to make an estimated tax payment on that income. Okay. And then the last piece of bucket of income that we're going to talk about is your business income. All right, your business income. And whether you are a partnership, an S Corp, or a sole prop, or a single member LLC, if you have any net profit from your business, all right, when all is said and done, you're going to owe income tax on that. All right. And if you're not making estimated payments throughout the year, then you're going to owe at the end of the year. Because unlike your W-2 job, where they just withhold some of that, right? When you are self-employed, when you have your own business, there's no one to withhold that money for you. Okay. It's your responsibility to make sure your estimated tax payments get to the government. All right. So if you have your own business, then it is your responsibility to make estimated tax payments. So we've done previous trainings on estimated tax payments. And so we're not going to spend a lot of time on it, but this is an old spreadsheet we had originally made for you guys and on one of my very first trainings. But Sarah went ahead and made it pretty for you guys. And so we made this spreadsheet for you guys. I've put the link in the comments. We've talked about this, but at the very least, if you do not want to deal with this spreadsheet, if you just want to do the absolute basic, all right, what you can do is look at your net income each quarter. All of your income minus all of your expenses equals your net income, okay? And then take that net income and pick a percentage, right? And pay that in for your tax. Okay, this spreadsheet is a step further, okay? It's going to take into account the exact dates. You're going to be able to put in. So let me show you. So let's say, your first payment period. Part of the problem with quarterly estimated tax payments is they're not exactly on the quarter, which is annoying, but it is what it is. So let's say we're going to make first quarter payment, and here what this says is we made $10,000. So it's going to tell you year-to-date net income because your year-to-date net income affects what tax bracket you're in, okay? And we're not going to go into detail on this because, again, it's all in another training, and we can do another training all on estimated tax payments. This spreadsheet is nice because it's going to be a little more exact on your actual income tax bracket, right? Instead of us just saying, okay, we suggest you pay in this much money because that's the most common tax bracket. This is actually going to tell you what tax bracket you are based on that income there, okay, that you've made year to date. And you'll see that's why it goes up, because this quarter, all of a sudden, our income is now high enough to kick us into the next tax bracket, the 22% tax bracket. Okay, and then this quarter, it kicks us into the 24. So it takes that into consideration. Then it also takes into account self-employment tax, which we've talked about. Okay, so it tells you your federal income tax percentage. So that's your income tax plus your self-employment tax percentage, right? So then it gives you your tax due. So that's the number you're going to pay. That's the amount you are going to pay that quarter. Okay. And then I put Colorado in here because I'm in Colorado, but if you're in a different state, that's all up to you. All right, and these are actually the 2020 tax brackets down here. So I just want to kind of share that with you guys. Again, I put the link in the comments for you guys to use at your discretion. All right. So again, we want to remind you that when you are making these estimated payments, whether you use my spreadsheet, whether you're using a more basic concept, whether you have an accountant advising you, make sure that those estimates are not only including your income tax, but your self-employment tax. All right, then you also want to see if you owe state. If you owe state, making sure you make those as well. Okay, so now let's get on to the actual, let me share some tax saving tips with you guys. So the first one, anytime you jump on a training with me, you're going to hear about it, but make sure you're taking all of your allowable deductions. Okay, guys, legit business deductions with support are not an IRS red flag. Okay, and even if they were an IRS red flag, okay, are you really going to leave money on the table out of the fear of that 0.1% chance of getting audited? If you are entitled to those expenses, take them. Okay, I know people who are like, I don't want to take that. I don't want to take my mileage because, I'm afraid that the IRS that's gonna raise a red flag with the IRS. Well, you guys, if you're tracking your mileage for your business, even if there's a red flag, you have the documentation to support it. Okay, an audit doesn't automatically mean more tax due. All right, and as long as you have your books in order, okay, and you're keeping track of the proper documentation to support your deductions, then there's no reason to fear an audit. Yes, it's going to be a pain in the butt, and it's going to, it's soul sucking and it's time consuming, but that's what it is. Okay. But if you're doing everything right, you're not going to end up owing more money just because you went into audit. So don't be that person that's scared to take your allowable business deductions because you are trying to avoid an audit. All right. There's no proof. There's no studies that say taking or not taking certain deductions are going to cause an audit. All right. And again, if you're being fair and you're taking legit deductions, you're fine. That said, I know a lot of people that don't know what all those business deductions are, right? They're like, I don't know what deductions I should be taking as a business, all right? Well, that's where you're going to want to talk to a tax advisor. I know on our website, we have an article that tells you the top 10 business deductions, right? If you're a client of ours, you get a spreadsheet that gives you the most common, categories of business deductions to take. All right. But if you are in business, this is something that you should know. You should have your head wrapped around this enough to understand what is a business deduction and what is not. All right. Because even if you have an accountant or a bookkeeper, okay, you're the one spending the money, right? So when you're there shopping, you need to know, is this a business expense or is this a personal expense? All right. And knowing what you can actually write off or deduct on your business return. So the next thing, and this is the one that's going to excite me and I'm going to go into a little bit more detail on, is contribute to your retirement account. All right, guys, contribute to your retirement account. This is the easiest way to cut your tax bill and invest more money into yourself. We have a whole training on retirement options coming up soon. I don't remember the dates for everything, but I want to talk to you today about the biggest and most underutilized or least taken advantage of retirement account. That's called a Sep Ira, SEP and IRA. You guys know what IRAs are. There's traditional IRAs, there's Roth IRAs. You hear the IRA, individual retirement account, thrown around all the time, but a SEP is a self-employed pension. Okay. And so this is going to be available to you guys no matter what type of entity you are. No matter what you are, you can set up a SEP retirement account, a Sep Ira retirement account with very, very little cost associated with it. All right. So I'm talking my sole props, my single member LLCs, my S Corps, even my partnerships. And we'll talk about making sure contributions are even. We'll talk about that at the end, but even my partnerships, all of them. And with a Sep Ira, you can go through pretty much any, financial advising company. And there is a very, very small administrative fee, especially if you compare it to like a 401k. The reason the Sep is this is the one I'm going to talk about today. And the reason it is so beneficial is because you guys can actually contribute up to 25% of your compensation or earned income. There's a slightly different adjustment made if you're going off like Schedule C income, as opposed to if you're like an S Corp and you pay yourself W-2 wages. For the sake of ease, okay, we're going to go with 25% of your compensation, up to $57,000 in 2020, you guys. That means you can have business income or self-employed income, whatever you want to call it, of over $250,000 and contribute 25% of that amount to your compensation. All right. So your sep contribution is great because it lowers your business income. It's not just a deduction to your taxes, right? So when you make a retirement contribution of like a 401k through your employer, or maybe you make a traditional IRA contribution, those lower your taxable income by that amount. Okay, we're good. So if you make a $10,000 401k contribution, it's going to lower your taxes by $10,000. It's going to lower your taxable income by $10,000. Okay, so any sort of retirement contribution is going to be beneficial. SEPs are even more beneficial because the SEP contribution is actually made by your business, not by you as an individual. So it's a business deduction to your business entity, which not only brings down your taxable income for your income tax, but it also brings down your self-employment tax. You know, that pesky 15 point something percent we just talked about. Okay, so you get to kind of double benefit from that. All right, so let's put it into math. Okay, so let's say you're able to make a $10,000 SEP contribution. Okay, your business makes a $10,000 SEP contribution to your individual bank account or SEP account. Okay. So this contribution is going to decrease your business income by $10,000 because remember, it is a business contribution. And if you are in let's say the 24% tax bracket, you're going to receive, right, a $2,400 decrease to your federal tax income, right? Because $2,400 is 24%. That's our tax bracket of the $10,000 contribution we made. All right, are you guys with me so far with the math? But in addition, sorry, my nose is in addition to that $2,400 that you're going to save in federal income tax, you're also going to save on that self-employment tax of that 15.3. It changes a little bit every year. So let's just call 15.3, might be 15.9, but it's just over 15. That's going to be over $1,500 that you save. So you're going to end up actually saving almost $4,000 in federal taxes by making a $10,000 contribution to your retirement account. And then in addition, you'll also save on your state income tax if you have a state income tax return. So because the SEP IRA contribution, guys, is made by your business, here's even better news about why a SEP is exciting. So because a SEP IRA contribution is made by your business, you as an individual can still make that normal annual IRA contribution max, which for 2020 is $6,000, $7,000 if you're over age 50. So my business can make the SEP IRA contribution of whatever amount they qualify for, up to that 25%, $57,000. And then I, on an individual level, can still make the $6,000 contribution. Okay. And again, if we're in the 24% tax bracket, that's going to save me another $1,440, okay, in federal income tax. Now, keep in mind, this personal IRA contribution doesn't give us that same benefit to the self-employment tax, that additional bonus. But if we're maxing out our SEP contribution at whatever our business can deduct, and then we still have money that we want to invest in ourselves, we can make that additional $6,000 to our to our IRA contribution. You can also, if you choose to, you can make that $6,000 contribution to a Roth IRA. We will talk about the difference in Roth, traditional, all those things in the retirement training. But I really want to focus on SEP because I know so many of you in here are single member LLCs, right? Or your sole props, and the thought of, opening a bank or a retirement account or all of it just seems like too much, or it doesn't seem like it's worth it. But you guys, it is, okay? It is worth it. So I'll continue. So if you are a business with no employees, this is a game changer, okay? Because any small business can do this. A side hustle, even if you have a W-2 job and they have a 401k plan that you're taking advantage of, your 401k contributions do not affect your ability to open a SEP IRA with your self-employed business, okay? So you can keep making those 401k contributions at your W-2 job, and then you can make your business that you have, your side hustle, can open up a SEP IRA account and make contributions to your SEP IRA, okay? So if you're the kind of person, if you are a person that has the side hustle for that extra money, for that extra, whatever, it can become a retirement planning tool. Excuse me. So I got a question. Sorry, I'm on StreamYard, so it just says Facebook user. So sorry. So it says, does the company open the IRA account? The company opens it, but you, like each individual within your company, if you have, let's say you have more than one, you'll have to have an account for everyone in your business. And I'll circle back around to if you have employees. But as soon as you go to your financial advisor, your company, and you tell them you want to open a Sep IRA, they will make sure they collect the proper documents. Because yes, you will have to have, if you have a business FEIN, you have to associate it with your business or your LLC if you have it. But if you're a sole prop, right? If you're a 1099, right? Maybe you're an Uber driver. So all of your side hustle income comes through just a 1099 to your social. You can still open a Sep, you guys. Seps are fantastic in this regard. They just have a lot of, a range of people they can serve. Okay, so again, if you have no employees, it's a game changer. If you do have employees, your business can still open a Sep IRA, but you have to contribute to all employees at the same percentage. Okay, so if you want to max out and contribute 25% to you, you also have to contribute 25% to every one of your employees as well. That aspect is typically why businesses do not use Seps when they have employees. But if this is something, maybe you're a new business, maybe you're just starting to consider hiring W-2 employees, maybe this is something you build into your compensation when you're offering compensation plans to your new employees. You say, okay, I'm going to pay you X amount of dollars, plus we do a 25% retirement contribution. It's not even a match. You don't have to put in 25%, but we will put in 25% regardless. And so it's almost like a 25% bonus, right? Or like pay increase. I do not know if Navy Federal offers this. Definitely worth asking. I think it's going to be more, I'm not sure, because like most of your banks and your credit unions, there's a lot of them that do offer regular, traditional, and Roth IRA accounts. I don't know if because this is a business account, I don't know if regular banks offer it, but it's worth asking for sure. Because if you can keep all your banking in one place, why wouldn't you, right? Finally, not the last piece of good news. I have a few more. So back to the Sep IRAs. So your Sep contributions, your business does not have to make these IRA contributions by year end, okay? You actually have until you file your return, your tax return, to make these contributions. So a lot of times this comes in to play when you're filing your return, because especially if you're a self-employed individual, right? I told you at the very beginning that when you're self-employed, when you're filing your return on a Schedule C, the calculation's a little different. Okay, there's a few tweaks that get made. So you can't just assume like, oh, I made $50,000, so I can just, put in $12,500. There's a few different things that pull into play. But as soon as you get your tax return completed, your Schedule C of your tax return completed, your accountant can say, okay, here's your Sep amount you can make, for your business. And then it becomes a deduction to your business, and you just have to make it by your tax filing deadline, which means if you file an extension, you have until October 15th to make that contribution to your Sep. All right. And this still applies for 19, you guys. If you filed an extension 2 days ago, or if you have an accountant, regardless, if you filed an extension 2 days ago, you now have till October 15th to file your tax return, which means you also have until October 15th to contribute to your Sep IRA. Now, there is a caveat that says the account needs to be established in the year you're contributing for, but I know for a fact every broker that I've worked with, the big ones, work around this. That's all I'm going to say about that. Not going to get myself in trouble. Talk to your financial advisor or find one. I have great recommendations if you want. So then again, we just talked about the Sep, but this whole thing goes into tax planning strategies, right? Tax saving strategies. So there are other retirement options for you if you're self-employed, if a Sep isn't right for your business. Maybe you have employees and you can't afford to make a 25% contribution. FYI, you can make less than a 25%, just to throw that out there. But there's also, there are solo 401ks, which are you cannot have employees for a solo 401k, but they're also a great option. Okay, there are simple IRAs, there are regular IRAs, we talked about those, and there's regular 401ks. And we will talk about all of those in that retirement training in a few weeks. Okay, guys? But regardless of which one you go to, all of them are going to offer tax savings to you. Roth IRAs do not give you tax savings now, but they will eventually. So all of these retirement account types will give you a tax benefit at some point. We'll talk all about them. in our retirement training. So the next tax savings tip, you guys, I want to talk about, and this is what I've been getting so many questions about. So if you don't have kids, you can tune out for 5 minutes. But the next tax savings tip is to hire your kiddos. Okay, you heard me correctly. Hire your kiddos. All right. So again, this is another thing we could have an entire training on. If there's enough of you that are like, yes, give me more info on hiring my kids, we can have a whole training on this. I've had just basic questions asked, so I want to include it here. So this is a great option to essentially opt for your kids to earn their regular allowance in a way that helps your business. Okay, and give tax advantage. Okay, so let's talk about it. What's the catch, right? So there's a few things you got to make sure you keep in mind. The two big ones, you guys, you have to make sure that the work and the pay that you're giving them is legit. Okay, the work you're giving them has to be actual work done in your business, and what you're paying them for that legit job has to be reasonable. Okay, it has to be reasonable. So you can't pay them $100 an hour to sweep the floors for 5 hours a day. That's sketch, right? But depending on the age of your kids, and depending on what you have in your business to do, right? Maybe they're scanning documents, maybe they're filing documents. Maybe they are cleaning the office, once a week they're coming in. Maybe you don't have an office job. Maybe, maybe you're manufacturing something, right? So maybe they can maybe they can actually help you make the products in some way, shape, or form. We have clients perfect example, we have clients who are rental management companies, right? And so they have their kids come help them clean the properties when it's time. All great ideas, okay? It just makes sure that the work and the pay are legit. All right, there are child labor laws that you're gonna be like, wait, that's always the next thing I get. There's child labor laws and my kid's only 10, I can't do this. Yes, you can, because you can follow the child labor laws. They don't say your children can't work. They just put limits on what they can do and how long they can work. But there's a very specific exemption to these child labor laws that says if you or your spouse are the only employers of your child, you are exempt from these labor laws. Meaning, if you're a sole prop or you're a single member LLC, you're good. If you're an S Corp and you're the only owner, you or your spouse, you're good. Or if you're in a partnership and it's just you and your spouse, you're good. All right. Yeah. Sequoia says, I opened Facebook so I can see who you are now. So Sequoia says, my son handles shipping products. Perfect. That's a great example. So yeah, just giving them jobs that they can handle, right? So child labor laws, you're exempt. Remember, the other thing, you're going to have to issue them a W-2, just like any other employee. So if you don't have payroll, because maybe you don't actually have employees, right? You are going to have to set up with a payroll company. Gusto is great for things like this. We love ADP, but we typically use ADP more for our bigger clients. But either one is a great stepping stone. The point is you will have to issue a W-2 to your kiddo. And so let me keep digging down this rabbit hole, shall we? So your child, you guys can earn up to the exemption amount, which for 2020 is $12,400, tax-free. I said that right. Your child can earn up to the exemption amount, which for 2020 is $12,400, tax-free. So you guys do the math. That's just over $1,000 a month. So I don't know about you, but I doubt I can find $1,000 a month for my kids to do. So I don't think staying under this tax-free threshold is going to be hard. My kids are 10 and 11. As your kids get older, 13, 16, you might be able to keep them busier longer, especially in the summers. But so up to that amount is tax-free. Income above that amount will still be a deduction to the business, right? It's still legit wages paid out, but then it's going to have to be reported on your kids' income tax return. So they may end up owing tax. Just keep that in mind. They may have to file a tax return and owe tax on their end, but it's probably still going to be advantageous because they're probably going to be in a low tax bracket and probably lower than yours, right? Right. Sequoia says, so do you have to pay them minimum wage? That I'm not sure about. I think that still falls under child labor laws, which means no. But that's not usually going to be the problem we get with, right? We're going to get to these, trying to pay our kids too much, right? Just to get that deduction. So I would say you're safe paying them at least minimum wage and not having any red flags raised because of that. So it doesn't really answer your question, but gives you a reason to pay the minimum wage. Where was I? So income. Okay. So your business also, this is the other thing. So your business, you guys, not only do we get to deduct those wages paid to our kiddo, right, as a business deduction, right? But we also, there is potential, I'll tell you about the loophole in a second, but there's potential that we will also get to not have to do the employment taxes. Okay, we won't have to pay the employment taxes, the payroll taxes. That's what I'm talking about, the payroll taxes on your child's wages. Okay, if you're a corporation, this does not apply to you, S Corp included. So you can still do this. You can still, if you're a C Corp or an S Corp, if you're a corporation, you can still employ your kiddos. You just don't get this added benefit of not having to pay payroll tax on them. Okay, but my sole props, my single member LLCs, you will avoid, my partnerships, you will avoid employment taxes on these wages. So Sequoia says, is a 1099 okay? It is, but a W-2, I would definitely suggest the W-2 because from your standpoint as the employer, okay, because they fall under this, unless you're a corporation, right? The money out of your pocket is the same, right? You're just paying their wages, whether it's a 1099 wage or a W-2 wage. There's no payroll taxes going on right now because we fall under this exemption. But if you pay your kiddo with a 1099, when they go to, they're going to have to file a return, and even though they fall under the income tax threshold where they won't owe income tax, they're going to owe self-employment tax because you end up losing that payroll tax exemption. Okay, so if you are hiring kiddos and you're trying to get that, you want to maximize your benefit, do it through a W-2 rather than a 1099. Great question, Sequoia. That is such a good question. Keep them coming, girl. So let's see. You could. Another thing that we like to suggest, that's the word I'm looking for, is to contribute some or all of your child's wages to fund a Roth IRA. So you're like, wait, what? So whether it's you make your kids work and then they don't even see $1 of it, that all goes to their retirement account, or maybe you split it. Maybe you tell them for every $1 they earn, 50 cents goes, whatever you want to call it. What we recommend you do is contribute some amount to a Roth IRA. So remember, or maybe let me tell you that a Roth IRA is taxable now. Okay, meaning it's not a tax deduction. Okay, so at the top of the training we talked about Sep Ira is an income tax deduction. Roth is not, right? Your income it's not a deduction to your taxable income. But if our kids are already under that $12,400 exemption, threshold, they don't have any income tax. So we don't care if it's tax deductible. But by contributing to a Roth now, even if they do pay tax, they're probably going to be in the 10% tax bracket, which is the lowest one, right? You put it in now and it's considered after tax. So it's going to grow tax-free. Because the reason Roth IRAs are so attractive is because, let's take another step. Let's take another tangent. Normal retirement contributions, pretty much everything else on the planet goes in tax-free, grows throughout the years, okay? And then when you take it out, it's taxed, principal and interest. Okay? There's a few different plans available, but for the most part, that's how it works. With a Roth IRA, you pay tax here and you won't pay tax again, okay? There are early withdrawal penalties or whatnot that you could be subject to, but if you know the rules, okay, when you take it out here, it's all tax-free, including interest. So if you're contributing even $1,000 a year to your, 15-year-old retirement account, by the time they're 60 years old, they're gonna have so much money and it's all gonna be tax-free, you guys, all right? Roths are good, sometimes, a lot of times. And then finally, your business could also make a sub contribution for your kids. So if you're the only employee and now your kid is also employed with you, when you make your 25% when the business makes your 25% sub contribution, the business can also make a 25% sub contribution for your child as well. Not the same as a Roth because again, it doesn't grow tax-free, but it's tax-free right now. So, and it's a business deduction. And if your whole goal is just to minimize that business expense, boom, there you go. All right, and so the last tax strategy I want to talk about today, and this is the one that I know everyone is listening into this training for, is electing to be an S Corp. All right, I get this question all the time. Should I be an S Corp? And my first piece of advice to you is this is not something you are going to decide to do without consulting an accountant, a good accountant. I'm going to give you some general guidelines on why. I'm going to tell you why it ends up being beneficial to a business, but that doesn't mean it's beneficial to your business. But if we're going through this and you're like, yeah, that's me, yeah, that's me, yeah, that's me, then it's time to talk to an accountant and be like, hey, I was on a training with my girl Bree, and she was talking about an S Corp election. Like, is that something that I should be, exploring? All right. So let's talk about why it's so attractive to small business owners. All right. And the biggest tax benefit comes from, God, I'm so sorry, my nose itches. The biggest benefit from a tax perspective of making the S Corp election comes from the savings you see on the self-employment or payroll tax. Okay. So let me put this with numbers. So let's say you have a single member LLC, right, that you're reporting on your Schedule C of your tax return, right? And we go back and we look at 2019 and we look at line 31 and we see your net income from your business was $100,000. Okay. Remember, net income is all of your income minus all of your eligible expenses. All right, so let's say you made $100,000. I don't know if this is a kick-ass year. I don't know if this is a normal year. Doesn't matter, okay? Right now we're just talking about numbers. So you made $100,000. So that $100,000 on your Schedule C is not only going to be subject to your normal income tax, you're also going to be subject to that additional self-employment tax that we talked about, which is 15.3%. Okay, so on $100,000 of taxable business income, you're paying an additional almost $16,000, right? Almost $16,000 in self-employment tax on top of whatever income tax you already owe, okay? And that number right there is what gets people. That's what ends up getting people. You guys, I have clients, okay, who have a business. They have, let's say this is their business, right? They have this income, and then they have these other maybe investments, maybe they have some other income, doesn't matter. And they have losses, right? And I've had clients where at the end of the day, they bring their net income down to zero. Okay, so they have no income tax, but they still have that darn self-employment tax because that happens. Okay, you can end up, when all is said and done, you can end up with no taxable income when you look at all of your combined income from all different places, but you're still going to owe that damn self-employment tax, okay? So S Corps are attractive because we can minimize that employment tax, all right? So let's take that same $100,000. Same business, same thing. 2020, we expect it to be the exact same. I don't know how that can possibly be with COVID-19, but humor me. Let's say we do. But this year, we knew we were going to have the same type of awesome $100,000, net income year. So we made our S Corp election. All right, we made our S Corp election, and we worked with our accountant, and we determined that $50,000 was a reasonable salary, because once you make that S Corp election, you guys, your S Corp, your business, has to pay you as a W-2 employee. Okay, has to. It's required. If you do not do this, the IRS has promised they will come back and hunt you down. Have they yet? I haven't seen it, but okay, there are case studies that say they have. So as soon as you elect S Corp status, your business has to pay you as a W-2 employee for the work you do in your business. So that's what we call reasonable compensation or reasonable salary. So you've worked with your accountant and we've said, okay, $50,000 is a reasonable compensation based on your business, all the stuff. So your business issues you as an individual a W-2, right? Because now you're an employee in your business for that $50,000. Your business then gets to deduct your wages from their income, right? So it was $100,000, but now they have this whole new wage, your wages that they get to deduct. They now get to deduct all the payroll taxes, the employer portion of the payroll taxes that they now have to pay because you're a W-2 employee, okay? So the business itself now ends up with less than $50,000, just under $50,000 in taxable income. So overall, your taxable income that's subject to income tax might be a little less, but it's going to be similar, right? So your income tax isn't going to change much by changing to an S Corp. But where we save is that money that the business now makes after we take out our payroll, that money is not subject to self-employment tax. S Corp income is not subject to self-employment tax, which is why they require the reasonable compensation. Kind of all clicks right together now. But by making this change in this example, we just saved ourselves about $8,000 a year in self-employment tax. Because yeah, we still had to pay the payroll tax on our $50,000 of W-2 wages, but that's it. This other $50,000 we got to take with no self-employment tax or payroll tax subject to it, okay? So we saved somewhere between $7,000 and $8,000 in self-employment tax. All right, and before I leave this section on S-Corps, I do want to tell you that there are additional requirements to consider before you jump on the bandwagon. And the reason I want to tell you this is because if you do not use us for your accountant, you could go to another accountant. They can be great accountants, okay, guys? But not all accountants, a lot of accountants are so quick to make this S-Corp election. They're like, yes, it's going to save you money. It's going to be great. But they don't talk long-term, and they don't tell you all the other stuff that comes with it. Okay. So I'm going to do that real quick. So when you make that S-Corp election as a corporation now, there are some other requirements you have to do. You have to do like this annual board meeting. Does that mean you just type up a meeting note and you sign it? Yes, but it's something you now have to do. All right. You now have to run payroll for yourself. Okay. So there's that added cost there. Now that you've elected S-Corp, you have to file a whole nother return. Your LLC was on Schedule C of your personal return. Now your S corporation has now you have two returns. Okay. So there's an added cost there. Okay. If your income is under what is determined to be a reasonable salary, you're going to lose the benefit of self-employment tax, but still have all this other baggage to deal with. Okay. So again, this is not something you should do without consulting a tax advisor. So updates. The biggest updates that have happened since I talked to you guys last. So raise your hand if you're sick of talking about the EIDL and the PPP. I am, but it's life now. So with the EIDL, which is the Emergency Injury Disaster Loan, the grant advance, the advance portion of that, the money that the $20 billion that was allocated to that ran out. I think it was last week. So the advance has been suspended. We are still uncertain what that means in terms of the people who had maybe applied when they suspended, but not yet got the grant. We don't know what it means for those people. So if you're one of those, let me know. But if you are just now applying for the EIDL, you will not get that advance. If you remember, that advance was a grant. It was tax-free money of up to $1,000 per employee, up to $10,000. Okay, that part is gone. You can still get an EIDL, like the actual loan, if you need funds. Okay, guys, and we've talked all about this, so I'm not going to go into it in depth, but the loan is still there. The advance is not. All right, and then in terms of the Ppp Loan Program. All right, and I know I've talked to you, but I want to remind you that the deadline moved to August 8th to apply. So if you're still like, I'm on the fence, I don't know, you have until August 8th to apply, but do it. If you are in any way, shape, or form thinking that you could use this money and use it in the ways that it is allowed to be spent, then you have until August 8th to do that. Remember that the new forgiveness rules from last month extended from you don't just have to spend your money in the 8 weeks. You now have a 24-week covered period to spend your PPP money. And it brought forth this easy forgiveness application. All right, which makes it a little easier. It makes it super easy for those of you that have no employees to file for forgiveness. And it makes it potentially easier for those of you that do have employees to apply for forgiveness. I have some really exciting news about people. Stay on here, guys. Stay with me for a few more minutes because I got good, exciting news. There is word what I keep getting DMs about is word of this new $150,000 automatic forgiveness to the PPP loan. I was talking to my friend Jamie Troll, who's in this group, but I don't think she's here right now. We're far from seeing this put into law. All right, Congress is on recess now. It hasn't even passed one side or the other. And because it's so far from being passed, we don't even know what it would end up looking like should it actually become law. Okay, so it's one of those things, we'll keep an eye on it, but we're not holding our breath, just letting stuff go out the window because we think we're going to get automatic forgiveness if our loan's under $150,000. So keep following the rules for now. Okay, keep doing all the things. Because even if they do automatic forgiveness, you guys, I'm guessing you're still going to have to certify that you spent it the right way and you spent it within the right amount of time and all these things. Okay, so keep following, use our PPP tracker that we've provided for you guys, to track your expenses, keep an eye on your forgiveness period, all the things. Okay, and we will absolutely let you guys know first if anything comes of this automatic forgiveness. Okay. I was talking to Jamie about this, and I think she gave a training in her group, Jamie Troll, and she was talking about if you're at the point where you're like, well, I'm done. I could apply for forgiveness because I'm ready, but you're not at the point where you have to yet, which nobody should be. It could be worth your time and money if you, if you have an accountant doing it for you, to hold off, to wait to apply for that forgiveness and see if they make this automatic forgiveness a thing. And one thing I learned from Jamie today in her training was that big banks are pushing hard for this because 85% of all PPP loans that were issued were under this $150,000 threshold. So if you're a big bank and you can get rid of 85% of your paperwork, heck yeah, you would, right? So it makes sense. And honestly, it makes sense because small businesses are under that $150,000 threshold, right? And they're the ones that maybe don't have a whole accounting department devoted to this. Okay, so we are going to keep an eye on this and hope for the best and hope that it passes. That said, this leads perfectly into our firm updates, which is the last piece of today. So we are actually going to offer PPP, and we can throw EIDL in there as well, consultations starting in August. So we do have a wait list. Let me put the link for the wait list in the comments, because I am still setting up a calendar, because I have a feeling a lot of people out there are going to want this. I need to decide how many people I want to talk to, as many as possible without burning out. But this link right here, oh, I didn't label it. Doesn't matter. This link right now, right there, will get you on the wait list for our PPP consultations, which will start in just a couple weeks. And that wait list, that way you'll get an email that tells you the first to know when my scheduling is open. All right, and we have a lot of other exciting things coming out, you guys, from our firm. But we're actually using this next couple of weeks to iron out the details and just make sure everything is ready for you guys before we make these big announcements. But get your hearts ready, okay? Especially if you're a client of ours, okay, or you're thinking about becoming a client of ours. Big news. And then I just want to end with a reminder that our offices are closed until August 3rd. If you want to see me because you like me and you miss me, you're going to have to see me here. But I'll be here on Monday early. We're going at 9 a.m. this next upcoming Monday, Mountain Standard Time, 9 a.m. Mountain Standard Time on Monday. All right. And then I will not see you next Friday because I'll be on a road trip. I know that doesn't sound safe, but we got it. And then, so the next 2 weeks will be kind of up and down, but I promise as soon as we get back on August 3rd, okay, we'll have new exciting information for you guys, and we'll feel better because we'll have taken 2 weeks off. So we'll feel rejuvenated. So, all right, I hope to see you guys Monday. Again, Monday at 9 a.m. Mountain Standard Time. It's an hour earlier than normal because I had to shift some stuff around. And so hopefully I'll see you then. All right, bye guys.